What's the best way to make retirement withdrawals in a bad market? I'm Mark Sabrin from TransCanada Wealth Management. Let's dig into it. When the stock market goes through a bad year, it can become increasingly difficult to make retirement withdrawals. We're all familiar with the investing adage to buy low and sell high, but without proper planning, you might find yourself in a situation where you're forced to sell your stocks while they are in a down position. Today, we'll be going over 2 common reasons that retirees are forced to sell their investments in a down market, and at the end of the video, we'll show you how to best set yourself up for future negative years. The first issue we see is oversimplification. Let me know if this sounds familiar. Bob has recently retired and would like to invest the proceeds of his pension. He meets with an investment advisor and they go through a risk profile questionnaire to determine what type of investor he is. He answers about 10 questions and it turns out that he's a balanced investor, and at this point, he's recommended a balanced investment. Bob agrees with the recommendation and he's now invested in the XYZ Balance Fund. He'll also be making his monthly withdrawals from the fund to pay for his day-to-day retirement expenses. A balanced investor will typically have about 60% of their portfolio in stocks and the other 40% in more conservative fixed income investments. Now, the stock portion can fluctuate quite a bit, whereas the fixed income portion should be more consistent. The issue with the XYZ Balance Fund is that the stock and fixed income portions are combined into one investment. So if the XYZ Balance Fund has a negative return, Bob will be making withdrawals in a down position. Looking back on 2022, it would not have been pretty for Bob. Here are the returns of Canada's largest mutual fund, which just happens to be a balanced fund as well. By the end of the year, the fund was down over 12.5%, and at its worst, it was down over 17%. So if Bob owned this investment in 2022, every time he pulled out money, he was in a loss position. To summarize, Bob only has one position, and if his fund is down, he'll be making withdrawals in a loss position. The second way we see retirees being forced to sell their investments when the market is down is a lack of a retirement plan. This often happens when the investment plan is not tied into a retirement plan. For example, Sandra has been drawing $4,000 a month from her retirement portfolio. She would also like to withdraw $35,000 to purchase a new vehicle. Sandra's investment advisor had never built her a retirement plan, so they were unaware that she was looking to make this purchase. The advisor was forced to sell a portion of Sandra's stocks to provide her with the cash that she needed to purchase the vehicle. So if the stock market happened to be down at that point, that withdrawal would have taken place in a loss position. All right, so how can you make withdrawals during a bad market? There are 2 components integral to a successful retirement withdrawal plan: the investment portfolio and the retirement plan, and they need to be aligned with each other. Step 1 is a retirement plan. A retirement plan will allow you to project your future income needs. This in turn allows you to plan out how much money you're going to need to draw on your portfolio every year. Let's take a look at Mr. and Mrs. Baker, who have recently retired and have put together a plan that goes over their cash needs in retirement. As we can see, this goes over the first 10 years of Mr. and Mrs. Baker's retirement. They're both receiving CPP and OAS, and we've also outlined the planned withdrawals that they're going to make from their portfolio. So as we can see in 2023, they're going to have to withdraw just over $26,000 from their portfolio, and then every year after that, it increases a little bit with inflation. The only outlier is in 2025, because in that year, they plan to purchase a new vehicle. Once the retirement plan is built, the investment portfolio can be created to line up with these planned withdrawals. So what does that mean? The issue that Bob was having is that his entire portfolio was in one balanced investment. So that means if the market was down and Bob's portfolio was also down, he would be making withdrawals in a loss position. Rather than having all of their eggs in one basket like Bob, the Bakers have been better served having multiple investments that coincide with when they need funds in retirement. After all, the money that they're going to need next month or next year shouldn't be invested the same way as the money that they're going to need 10 years down the road. The Bakers are using what we like to call the bucketing strategy, and it usually entails 3 buckets. The first bucket is meant for funds expected to be used within a couple of years. If we go back to the Baker's plan, we can see that they require just over $26,000 from their portfolio in 2023 and slightly more in 2024. Since they need these funds in a relatively short amount of time, this piece of their retirement portfolio should be invested extremely conservatively, such as in a savings account. Now, the second bucket is for the funds that they expect to spend in years 3 to 7 of their retirement. In the Baker's case, these are the funds that they'll need from 2025 to 2029. Now, similarly, they would need to calculate how much they expect to withdraw from their portfolio in those years, and since these funds are required relatively soon, this bucket should be invested conservatively. And the third bucket is the money the Bakers will require for the remainder of their retirement. Since they don't need to touch this piece of their portfolio for many years, it can be invested more aggressively. We've previously discussed the bucketing strategy, and if you would like a more detailed breakdown as to the intricacies as to how it works, check out the link above. So to summarize, how can you make withdrawals in a bad market? Well, step one is to have a retirement plan that goes over your cash flow needs in retirement. And once you have that built, then your investment portfolio can coincide with that plan to make sure that you're not making withdrawals in a down position. If you enjoyed today's video, hit that subscribe button and we'll see you next time.